Hey, what's up, guys? Welcome back to another exciting, well, is it going to be exciting? We'll find out. Monthly webinar about what and the hell is going on in this crazy real estate market. We've got interest rates still going up. We've got housing. Is it still going up? Is it slowing? Are we getting more inventory? How's the foreclosures? Like, what is going on? We're going to take a deep dive. This month, we're definitely going to go back a little bit in the history because over the last, since the beginning of the year, it was people worried about, it was talking about the rising rates. Then it was talking about inflation. Then it was talking about no inventory. The conversation is kind of changing to, are we going to have a recession? The rates are even higher. There's still a problem with inventory. Is the high rates slowing down the housing market? Are we going to have a crash? So the top of people's mind is definitely changing. Consumer, I think, is pulling back. The Fed is definitely really wants to slow this economy down, and they're raising rates. So let's jump into it. If you guys don't know who I am, if you've never seen my monthly webinar, my name is Kenny Simpson with the Simpson team. I'm a loan officer at C2 Financial. I'm a mortgage broker by choice. So I'm excited to be here. Thanks for your time. If you guys ever have any questions or want to talk to me, my contact information is below. Love to chat. Love to answer any questions. I focus on 1 to 4 unit financing, whether that's first-time home buyer or you're active retired military or you're self-employed and hard to qualify, or you're a real estate investor. And that's where we are. So I'm excited to jump into May. Remember, May is May, but this is looking backwards into April. So why we are not headed for a housing bubble. So I have this conversation every week, maybe sometimes daily, because people are definitely freaked out. And I tell people, don't listen to anybody, just look at the data. And that's what we do on this monthly webinar. We literally just go over the data and we look at it, we talk about it, and you guys can share this with friends, family, clients. If you want a copy of yourself, please reach out to us and we'd love to give you one. Home price appreciation since World War II. Well, this is time. What's cool about going back is you can just see like how much, what you see here is really the growth of the population of the U.S. from 1945 till today. Obviously, through a couple of different generations here, buying properties, probably from 1945 to now. We're talking about great grandparents and grandparents and parents and us youngsters. So pretty cool. Look at these charts. It's really cool to go. Sometimes when you guys are really lost, confused about stuff, and you want to look at data, go look at data. Don't go research something to hear somebody's opinion. Just go look at the data. Okay. Forbearance numbers edge downward. So one of the things we discuss we've been looking at month over month over month. So foreclosures, we thought COVID hit, it's going to be skyrocketing. There's going to be all these foreclosures. Well, unfortunately, guys, that was not the case. The foreclosures did not happen. And we're going to go into a slide or two and we're going to find out what happened. Where are they? Why didn't they happen? Like 5, 6 something million people were not making their mortgage payments, right? Oh, why didn't they get foreclosed on? So we'll find out. Right here, 37% were paid in full. So anybody that went into forbearance, then they'd go to forbearance, either do a short sale or foreclosure. Out of all these people, this is what happened. 37% were paid in full. They caught up, they refied out, whatever. 44 were in workouts or repayment plans. And then 18.4 were still in trouble. And this period is from June 1st, 2020 through March 31st, 2022. And you can see 1.3% short sales, deed in lieu, and repayment plans. So, this is what's happened. So basically, as I will mention to you, and I always mention on every video, every month, when we go over this, that I truly believe the last housing crash, the last financial crisis we had, not before COVID in 2008, as soon as it hit, people's credit went down rapidly. They missed car payments, credit card payments, housing payments, got foreclosure on short sales. The banks are into taking your money and the banks are into lending your money. They are not into managing a bunch of foreclosures and short sales. That's not what they want to do. I truly believe that when COVID hit, obviously the government had some influence and said, hey, we really need to give these people some time. This is a small period of time. And they worked with people, helped them out. Some people might think this is ridiculous. They got a free lunch, they got this. Look, it's not ridiculous. This probably helps save, a depression, not just in housing. Look, if housing crashes, a lot of stuff's going to go with it, just like 2008. Nobody really wants to relive that. I know some of you guys are watching this go, man, but I wanted to get those cheap deals and those. Well, you're going to have to go find other ways to do that, not through this way. So I think they learned. And also remember, if we knock out the consumer and ruin their credit, that's 70% of the economy. That's a problem. And 70% of those people, no, it's not, sorry. So the 70% that actually spend money, majority of them use credit to actually buy stuff. So if they're non-bankable, non-financeable, have no money, no credit, and they can't buy stuff, that's a bigger problem for you and me. We have learned from history that prices can fall. The more important question is if it's going to happen right now, and that's hard to say. Well, it is hard to say, guys. I think time will tell. And, like I said, keep looking at the data. The data doesn't lie. Lending standards like nothing in the early 2000s. So I was a lender, broker in the early 2000s. And I can tell you, unfortunately, but anybody can say this, we did loans and we said, wow, I cannot believe they funded that loan. Well, today, that's not really going on. The small percentage of loans getting done are the non-QMs and maybe bank statements and self-employed, but the profile of the borrower is way different. Higher credit score, higher net worth, better income, better assets, more equity. So it's completely different. The 100%, 100%, zero down, stated income, stated asset, those days aren't here. That's where we had problems. So as you can see, the borrower risk is way down, which is great news for all of us. Foreclosure activity, as we went over before, here's the numbers, here's the data. It's an all-time low. You can see in 2008, 9, 10, 11, 12. For example, 2012, 35% of sales in 2012. Look, there are 1.8 million sales. 35% in 2012 were of foreclosures and short sales. Today, it's 1%. So you can imagine in 2008 and 9, it was probably 50, 60% of markets. Some markets, it could have been 80%, which is insane. Maybe like in Vegas, Arizona, some Florida parts, maybe some parts in California. Insane. Lending standards are tighter since crash. I'm just telling you guys, most of the deals we do, it's full doc, great income, great assets. It's completely different. So if you're in my industry and you're now compared to then, you don't even have to talk about this. It's clear as day. Things have tightened. It's so much different, from documentation to how we disclose, to the clients get the acknowledgement. There's an extra 3-day period cool off, the CD, to make sure you really want to sign. They've changed some things, and sometimes, look, it's a pain in the ass, but it's really for the better. We don't want these ebbs and flows in real estate. We'd rather have, I know it's been kind of crazy lately, but when you have bad lending standards, you are for sure eventually going to have a massive crash, because if you give loans to people that shouldn't have them, it's going to be a problem. Mortgage debt is not a challenge. Household debt service ratio for mortgages as a percentage of disposable personal income, total quarterly required monthly payments divided by totally quarterly disposable personal income. So it's actually, wow, surprisingly it's low. That's because we had low rates. A lot of, most people refied. So that's what people got to remember. A lot of people refied into lower rates, lower payments. So a lot of people are sitting really good right now, in a really good position. They got cash in the bank, their credit's good, maybe not much credit card debt, and they got a low mortgage. Not everybody, but there's a decent amount of people that refi to have lower payments. Mortgage payments, virtually unaffected. Difference in annual payments for cash out refinances. Interesting chart. How much lower the payments are because rates. What's ahead? Jump there. Estimated home price performance. I think we all can agree that housing is probably going to. We're not saying it's not going to crash, but we don't know. But what we're saying is the appreciation is going to slow. It has to slow. That's higher rates. Just going to happen. If rates come tumbling down, that could be a different story. But right now, it's going to slow. House appreciation by 2026. there's all your optimists, all panelists, pessimists. So interesting. Still a lot of appreciation. Home price forecast for 2022. The average is 9.0. I think last time it was 7.5. I think these people have come up with their numbers. So it's interesting. Remember, we look at this month over month. So we take a month and then we look at the new month and then we look backwards at what happened. And you're seeing clearly that all these, the Freddie Mac, the Fannie Mae, the CoreLogic, all this, it's changed. Based on the current estimate for the peak Fed funds rate, 3.25 to 4%, that's when Jerome Powell comes out and says, I'm going to raise rates. The 30-year fixed mortgage will likely peak between 5 and 5.75. There are some variable in the relationship, so we might see rates as high as 6. I think there's rates at 6. Certain lenders that have more margin, have more overhead, whatever built in, they're there. So 5 to 5 and 5.7, we're already there. This all depends on inflation, the Fed funds rate, but I don't expect rates to move much higher than the current rate, although 6% is possible. Like I said, I think with certain lenders, you might be there, especially on investment properties and things like that. Affordability. New data from the Harris poll shows 84% of Americans plan to cut back spending as a result of price spikes. More than 70% of respondents said they're feeling the effects of inflation, most in gas prices and groceries. We all know that. We all live in this world. Whether you make a little bit of money, a lot of bit of money, you're aware of it. So some of it's definitely affecting more people than others. So it's definitely, look, by the time you pay your rent and your gas and your food and all this, there's less left over, which is left to go buy other goods, which is going to affect the economy. This is an awesome chart. Change in mortgage payments. So a loan amount of $300,000, principal and interest payments only. So 2.73%, right, back in January 2021 was $1,200. Today, 5.5 is $1,700. You're almost a $500 difference. Yowzers. There's affordability problems. Look at the difference. It's insane. And you can see how the rates gradually, look, January 2022, the rates were still 3.44. We're like, oh no, they're going high. Yeah, if you can go back to those days, huh? Affordability approaching historical levels. Obviously, we already know that. This is across the board. This is affecting everybody, but this is the reality. Years when distressed properties dominated the market. Wow, look at that. It's crazy. The average consumer is spending an additional $429 a month for items other than shelter. Meanwhile, average weekly wages rose $212 per month. So the consumer is short by $217. This means that the average consumer will be looking for a home that is $41,000 cheaper. Wow. I actually put out another post recently where it says the raise went to 0.5, but the consumer, like the commodity prices of what we buy, went to 0.9. So like it's a -4. There you go right there. So 217. It's crazy. It's not good. So obviously the Feds are trying to, have a recession, which should bring down commodity prices. Home sales. Average days on the market. Honestly, guys, still the same here. Month over month, I feel like we're in the same boat. I'm going to move along this. We've seen this chart all too often. Not much change here. Total home sales volume in the thousands. You got that. And home prices. Year over year, they're still, I'm not saying they're just, jacking up, but there's some appreciation. They're not falling. Maybe in some areas they're having price reductions. But I think people are also trying to list crazy prices. Seller traffic, well, there's not much of it because nobody's selling. Month inventory of home sales. We have 2 months. So I'm just looking here, going back. Wow, it's crazy. Only 2 months. So looks like January was the lowest. February, March. So we're coming up a little bit. So that's good. We're getting a little bit of inventory. 121 markets nationwide see double-digit home showings per listing. Year-over-year increase in showing activity, March 22. Michael Lane, Vice President, General Manager, showing time. We are sensing a slight slowdown in the western region of the United States in year-over-year showings index. Although there is still a very strong activity, the demand per listing is still at historical unprecedented levels. But for now, first time in 12 months is neutral. So basically, you're just seeing a little bit of buyer demand back off. That's obviously because of the rates. Buyer traffic, there you go. Still really strong across the board. Mortgage rates, well, there you go. We are definitely getting up there. So this is definitely having an effect across the board. Rates look like we surpassed 2018. Mortgage rates projections. Well, it's funny when we go back and look at this in January, how much different it is now. But there's your projections. I mean, we're already there. So we'll see what happens. You notice nobody's saying the rates are going to be lower by. Let's see here. Nope, nobody says the rates are going to be lower. They still thinking pretty high rates into Q1 and Q2 of next year. Interesting. Mortgage rates projected. There you go. They're saying we probably had the big rise, and now you're probably going to see them just maybe hovering around here. We'll see what happens in the overall economy, stock market. Hot product. So super excited about this one. 2 to 4 units, 15% down. So with Frannie and Freddie, okay, Frannie and Freddie, you can do 15% down on a 2 unit. FHA, you can do 3.5% down on a 2 to 4 unit. But remember, on 3 to 4, it has to pass the self-sufficiency test. That means the property using 75% of the gross rents has to basically be a little bit more income to the total payment. So in San Diego, very challenging to do. But on FHA, most people do a 2 unit, 3.5% down. That's a great deal. VA, best mortgage out there. You can do 100% financing with 4 unit. But this, I'm excited about. You can go buy a 4 unit with 15% down. And the thing I love about this is there's no mortgage insurance with this particular product. It is a bank, a portfolio product. Interest rates on ARMs are going to start in the high 4s and 30-year fixes in the low 3s. So if you have questions about that, I think it's awesome. A lot more people here in San Diego because of affordability. They're going into 2 to 4 unit properties, maybe a house in the front, units in the back. Have those tenants help pay the mortgage. And that's it. So appreciate you guys watching. What we're really seeing here is clear. We are seeing month over month, everybody's getting a little bit more nervous. Everybody's getting a little bit more freaked out because rates are going higher. Inflation hasn't come down. One thing we don't talk about here is consumer credit card debt is super high right now. Savings rates gone down. Affordability is not going down. And then there's a looming recession. And the feds are, want a recession, and we need to get inflation under control. And then we have other things like the war in Russia with Ukraine and stuff. So there's a lot of things going on here, but real estate has just no inventory. So we're seeing massive, there's still just a lot of issues there. No inventory, and it's causing a problem for buyers. So just today, as I shoot this before, my client's for a second home up there in Northern California in the mountains, he's gonna probably overpay. And that's just what it is. So it's still happening, and there's still demand. There's just no inventory. Here in San Diego, the inventory is down 85%. So thanks for watching. If you guys have any questions, here's how to reach me. My phone number, email, website. If you guys want a copy of this, let me know. If you wanted me to do a live presentation for a client or anybody, just let me know too. We can do a Zoom where I can come in. Thanks for watching. Until next time, we'll see what happens.